Welcome to Lecture A2, Types of Business Entity. Now, this might sound like a dry admin topic, but trust me, it underpins everything in financial accounting. Whether you're reading a set of accounts for HSBC or a local corner shop, the legal structure of that business changes what statements you see, who's liable, and how profits are paid out. By the end of this lecture, you'll be able to spot the entity type from a two-line exam scenario and pick up those easy 2 to 4 marks without hesitation. This is a Level 1 conceptual topic, no specific International Financial Reporting Standards, or IFRS, reference is needed. It's pure understanding. The difficulty is low, but the marks are real. Expect 2 to 4 marks per sitting, usually as multiple choice questions. Don't underestimate it. Students who rush this topic and muddle up liability types or mix up drawings and dividends drop easy marks every time. Right, let's open with the big picture. Why does entity type actually matter for an accountant? Let's find out. Before we dive into definitions, let me give you the frame. Every business you'll ever account for falls into one of 3 broad camps, and the camp it sits in changes almost everything about how you treat it. The 3 core structures are sole trader, partnership, and limited company. Think of a freelance graphic designer working alone. That's your sole trader. 2 lawyers sharing an office and clients, partnership. And Cathay Pacific Airways, with thousands of shareholders, that's your limited company. Same basic idea of a business, 3 completely different legal worlds. Each structure comes with its own legal consequences, tax treatment, and reporting duties. A sole trader pays income tax on profits personally. A limited company pays corporation tax. Those are different tax regimes entirely, and that distinction flows straight from the entity type. Here's why this matters for the exam practically. The entity type determines which financial statements are legally required, whether an audit is mandatory, and crucially, whether the owner can lose their house if the business collapses. That last point is what liability is all about. Once you get to group accounting and full IFRS application later in your studies, you'll realize that IFRS almost exclusively applies to incorporated entities, companies. A sole trader doesn't file IFRS accounts. So this topic is your foundation for everything that comes after. And the exam skill being tested here is simple pattern recognition. If the question says Ahmed runs his own plumbing business and keeps all the profits himself, that's a sole trader. If it says the board declared a dividend, that's a company. Train yourself to spot those clue words and the marks come easily. Right, key definitions time. Let's nail the unincorporated side first. These are the entities that exist without formal registration as a company. Let's build these definitions properly. Don't just memorize them, understand why each one exists. A sole trader, 1 person, 1 business, no registration as a company required. The reason this term exists is to describe the simplest possible business structure. Think of a hawker stall owner in Hong Kong running their own food business. They own it, they run it, they keep the profits. But here's the critical point. Their liability is unlimited. If the stall runs up $200,000 of debt and folds, creditors can come after the owner's personal savings, car, even their flat. A partnership is 2 or more people carrying on a business together with the aim of making profit. The classic example is a law firm or an accounting practice with multiple named partners. Profits get shared, maybe 60-40, maybe equally, per the partnership agreement. And just like a sole trader, in a general partnership, every partner faces unlimited personal liability. If your partner makes a terrible business decision, you could be liable for their share of the debts too. That's the real risk. Now the limited liability partnership, or LLP for short, is a hybrid. It looks like a partnership on the outside, but it's been formally registered and has its own separate legal identity. The big upgrade is that partners' personal liability is limited to what they've put in. Many large accounting firms, Deloitte, KPMG, operate as LLPs for exactly this reason. The partners don't want to risk losing personal assets if a client sues the firm. Unlimited liability is the concept that ties sole traders and general partnerships together. It means there is literally no cap. If the business owes $500,000 and only has $50,000 in assets, the remaining $450,000 can be claimed from the owner's personal wealth. Your savings account, your property, all fair game. This is the single biggest risk of unincorporated structures. Now the incorporated side, these entities are legally distinct from their owners, and that distinction is enormously powerful. A limited company is a separate legal entity. It exists in law as its own person, entirely distinct from its shareholders. MTR Corporation is a company. Its shareholders include the Hong Kong government and thousands of individual investors. If MTR had financial problems, creditors go after MTR's assets, not the shareholders' personal bank accounts. That protection is the whole point of incorporation. Separate legal personality is the legal doctrine that makes this possible. The company can own property in its own name, sign contracts, borrow money, and even be taken to court, all independently of whoever owns the shares. A famous legal case from 1897, Salomon v. Salomon, established this in English law. The company is its own legal person. That concept is tested indirectly all the time in ACA. A private limited company, written as Ltd., is a company whose shares are not available to the general public. A family-owned manufacturer in Hong Kong with 5 shareholders, that's a typical limited. You can't just go and buy shares in it on a stock exchange. Share transfers usually require the approval of existing shareholders. Governance is simpler, but the trade-off is limited access to capital. A public limited company, or PLC, is at the other end of the spectrum. Its shares are listed and traded on a stock exchange. Think HSBC Holdings plc on the London Stock Exchange. Anyone can buy a share. But with that access to public capital comes the highest regulatory burden, mandatory audits, prospectus requirements, exchange listing rules, quarterly reporting in some jurisdictions. The more you take from the public, the more you owe them in disclosure. Limited liability is the matching concept to unlimited liability. Here, your loss as a shareholder is capped at what you paid for your shares, or what remains unpaid on them. Say you bought 1,000 shares at $1 each and paid in full. Worst case? You lose $1,000. The company owes millions to creditors? Not your personal problem. Your house, your savings, protected. This is why people incorporate. Now let's talk principles, the conceptual rules that explain why these structures work the way they do. 5 principles total, starting with the 3 most fundamental. 3 principles here. Each one answers a why question about entity structures. Principle 1. Incorporation creates what lawyers call the veil of incorporation. Imagine a curtain hanging between the company's debts and the shareholders' personal wealth. Creditors can only reach what's on the company's side of that curtain. Without incorporation, sole trader, general partnership, there's no curtain. Everything is exposed. This is literally why entrepreneurs choose to incorporate before taking on big financial risk. Principle 2. As ownership becomes more complex, so does governance. A sole trader answers to nobody but themselves and HMRC. A private limited company needs a board of directors, must hold annual general meetings, AGMs, and must file statutory accounts with Companies House every year. Why? Because once other people's money is involved, accountability structures are legally required to protect those investors. Principle 3. Capital raising ability grows with structural complexity. A sole trader is entirely dependent on their own savings and perhaps a bank loan secured against personal assets. A partnership pools the capital of multiple individuals. A Ltd company can issue shares to investors. A PLC can raise hundreds of millions from the public on a stock exchange. Cathay Pacific raised fresh capital through a rights issue during COVID, something completely impossible for a sole trader. 2 more principles. These cover regulation and longevity, both of which matter hugely in practice. Principle 4. Regulation is proportional to public accountability. If you run a sole trader business, your main obligation is filing a personal tax return. Nobody else really cares. But a PLC takes money from thousands of public investors, so it must comply with company law, stock exchange listing rules, produce a prospectus when issuing shares, publish detailed financial disclosures, and submit to mandatory independent audit. More public money at stake means more rules protecting that public. Principle 5. This one surprises students. If a sole trader dies, their business legally ceases to exist. It dies with them. A partnership can dissolve if a partner leaves or dies, unless the agreement says otherwise. But a limited company has perpetual succession. HSBC doesn't cease to exist if its CEO dies. Shares transfer, directors change, but the legal entity continues indefinitely. That continuity is essential for long-term business planning and investor confidence. Let's bring all 5 entity types side by side. This comparison is exactly what exam questions test, so pay close attention to each row. Sole trader, one owner, unlimited personal liability, and no separate legal personality. That means if you're the sole trader and the business owes money, you owe money. No legal protection whatsoever between you and those debts. Partnership, 2 or more owners, still unlimited liability for each partner in a general partnership, and still no separate legal personality. Here's the real danger. Joint and several liability means creditors can pursue any partner for the full debt, even if it was caused by your co-partner's actions. That's enormous personal exposure. LLP, this is where the shift happens. Still looks like a partnership operationally, but the LLP is a registered separate legal entity. Partners have limited liability. So if the LLP's clients sue for $10 million, the partners don't lose personal assets beyond their capital contribution. That tick next to separate legal entity is the game changer. Private Ltd shareholders, limited liability, separate legal entity. A small family company manufacturing clothes in the new territories fits here perfectly. The shareholders put in their capital, and that's all they can lose. Creditors cannot touch the shareholders' personal property. PLC, same protections as a private Ltd, but now the shares are publicly traded and the regulatory burden is at its highest. Think of any Hang Seng Index constituent company, mandatory audit, exchange disclosure rules, prospectus obligations. Most regulated of all entity types. The master split to remember for your exam: incorporated entities, Ltd, PLC, and LLP, give you limited liability and separate legal personality. Unincorporated entities, sole trader, and general partnership give you neither. That one sentence answers probably half the questions on this topic. Now let's make this practical. Exam scenarios give you clue words, and your job is to decode them quickly. Let's practice. If a question mentions shareholders or share capital, it's a limited company, full stop. Sole traders and partnerships don't have share capital. They have capital accounts. So, share capital of $500,000 instantly tells you you're dealing with an incorporated entity. If a question mentions partners sharing profits, your first instinct should be partnership. But immediately ask yourself, does the question say LLP or mention limited liability for partners? If so, it's an LLP, not a general partnership. The liability treatment is completely different between the two. Single individual, trading under their own name or a trading name, no registration as a company, that's your sole trader. Ahmed trades as Ahmed's Plumbing Services, sole trader. Simple. Board of Directors, AGM, or phrases like, the company has limited liability, all scream corporate entity. Directors exist because companies need individuals to act on behalf of the legal entity, since a company, being a legal construct, can't physically make decisions itself. This one is a classic exam trap, profit distribution terminology. A sole trader or partner takes drawings from the business. They're withdrawing their own money. A shareholder in a company receives dividends, a distribution of corporate profits approved by the board. Use the wrong word in an answer and you'll lose marks. Always match the term to the entity type. Finally, the Statement of Financial Position, SOFP for short, is required for all limited companies as part of their statutory accounts. Sole traders often prepare one for management purposes, but it's not a legal obligation. For Ltd companies, it's non-negotiable. Reporting obligations vary dramatically by entity type, and this is tested directly in MCQs. Let's map it out. A sole trader prepares financial statements primarily for two purposes: working out taxable profit for the tax authority and for the owner's own management decision-making. There's no legal requirement to file these publicly or have them audited. They're entirely private documents. Partnerships similarly prepare accounts for the partner's use to show each partner their share of profit and what they're owed from the business. There's very limited public filing requirement for a general partnership. Partners share the accounts among themselves, and that's largely it. Limited companies are where statutory obligations kick in hard. They must prepare accounts following IFRS or IFRS for small and medium-sized entities, IFRS for SMEs, or local generally accepted accounting practice, known as GAAP. Which framework applies depends on jurisdiction and whether the company is publicly listed. Every limited company must file its accounts with a public registry, Companies House in the UK, the company's registry in Hong Kong. This is the price of limited liability. You benefit from personal asset protection, so in return the public gets to see your financial information. This is why company accounts are publicly searchable. Small private limited companies often qualify for audit exemption. They still must prepare and file accounts, but they don't need an independent auditor to sign them off. The threshold varies by jurisdiction, but typically involves turnover, asset size, and employee count. Don't assume all Ltd companies must be audited. Small ones often aren't. PLCs face the full package: mandatory statutory audit, interim financial reports, stock exchange disclosure rules, and strict deadlines for filing. There are no exemptions here. If you're a listed company taking money from the public, full transparency is required. Always. Right? Pitfalls. These are the actual mistakes students make under exam pressure. Let me walk you through each one so you don't fall into the same traps. First pitfall: students know sole traders have unlimited liability, but forget that general partnerships are equally exposed. Every single partner can be pursued personally for the full debt of the partnership. Imagine two architects in a partnership and one makes a catastrophic error on a project. The other partner, who had nothing to do with the mistake, can still be personally sued for the full amount. That's joint and several liability in action. Second pitfall: students sometimes write things like the company's owner, as if the owner and the company are the same thing. They are not. A company is a legal construct. It exists on paper, in law. It can sign a lease, own a building, and be taken to court entirely independently of its shareholders. Salomon v. Salomon established this over a century ago. The company's assets are not the shareholders' assets. Third pitfall: treating all companies as identical. A private Ltd company has no obligation to list on any exchange, faces lighter regulation, and may qualify for audit exemption. A PLC must maintain minimum share capital, £50,000 in the UK, follow exchange listing rules, publish a prospectus for new share issues, and submit to mandatory audit. Don't treat them as the same thing just because both have limited liability. Fourth pitfall: this costs marks in written answers regularly. Sole traders and partners take drawings. They're withdrawing money that belongs to them as the owner. Shareholders receive dividends, a formal distribution of corporate profit, approved by the board, paid proportionally to shareholding. These are different concepts, different accounting entries, and different terminology. Mix them up and the examiner knows you haven't understood the entity type. Fifth pitfall: saying partnership and automatically assuming unlimited liability. That's only true for a general partnership. An LLP is formally registered, has separate legal personality, and gives partners limited liability protection. Large professional firms choose the LLP structure deliberately. Always check whether the question specifies general partnership or LLP before answering any liability question. Quick recap before we hit the practice questions, 6 key points to lock in. Sole trader and general partnership, unincorporated, unlimited liability. Both owners are fully exposed to personal claims from business creditors. No legal curtain between them and the business debts. Limited company, PLC, and LLP, all incorporated, all limited liability, all separate legal entities. The company or LLP owns its own assets and owes its own debts. Shareholders and partners are protected beyond their investment. Governance burden runs on a spectrum. A sole trader sets their own hours and answers to nobody. A PLC has a full board, audit committee, AGM obligations, exchange rules, and thousands of shareholders to satisfy. The more complex the ownership, the heavier the governance. Capital access mirrors that spectrum exactly. A sole trader uses personal savings or a secured bank loan. A PLC can raise hundreds of millions through a public rights issue. Greater structural complexity unlocks broader capital markets. Terminology matters enormously. Sole traders and partners take drawings. Shareholders receive dividends. These are not interchangeable. One wrong word in an exam answer signals a fundamental misunderstanding. And finally, on reporting, all limited companies must file a SOFP with the public registry. But small ones may qualify for audit exemption. The obligation to prepare and file is universal. The obligation to audit is not. That distinction is a live exam question. Excellent. We've covered all the theory. Now let's put it to the test. We've got 5 multiple-choice questions and 2 short-form questions coming up. Work through each one yourself before looking at the answer. Question 1. Read it carefully. Which statement about a sole trader is correct? The word correct means 3 options are false. Your job is to find the one that is definitively true. The key terms here are sole trader. Think about what we know. No incorporation, no separate legal personality, no mandatory audit. Hold that framework as you read the options. Option A says limited liability. That's the exact opposite of what a sole trader has, but it's tempting because students mix up the word limited with small company. Option B says separate legal entity. Again, the trap here is that students sometimes assume all businesses are legally separate from their owner. They're not. Option C says personally liable for all debts. This aligns perfectly with unlimited liability and no separate personality. Option D says must publish audited statements. Sole traders have almost zero regulatory obligation to publish anything. C is looking very strong. The answer is C. A sole trader is personally liable for all debts of the business. This is the direct consequence of unlimited liability combined with no separate legal personality. Owner and business are the same legal person. All business debts are legally the owner's debts. Option A is wrong because liability is unlimited, not limited, the opposite. Option B is wrong because a sole trader has no separate legal personality at all. The whole point is there's no legal distinction between owner and business. Option D is wrong because sole traders face no obligation to publish or audit financial statements. That obligation is specific to limited companies. Common mistake. Students who mix up sole trader with small company often pick A or D. Don't conflate smallness with the sole trader structure. Question 2. This one asks for a feature of a limited company that a sole trader does not have. So you need to find the distinguishing feature, something exclusive to companies. Notice the phrase key feature. You're looking for what makes a company structurally different, not just operationally different. Option A, owner can take drawings. Careful, both can do this. A sole trader takes drawings, a company director can take a salary or dividend. Both involve the owner extracting value. Option B, separate legal identity. This is your fundamental structural difference. Only companies have this. Option C, prepares a statement of profit or loss, or SPL. Both entity types can prepare one, even if only Ltd companies are legally required to. Option D, can hire employees. A sole trader absolutely can hire staff. That's not exclusive to companies at all. B is clearly the answer. The answer is B, separate legal identity. This is the defining structural difference that incorporation creates. The company exists as its own legal person, capable of owning assets, incurring liabilities, suing and being sued, entirely independently of its shareholders. Option A is wrong because both entity types involve the owner extracting money. The terminology differs, but the concept of withdrawal exists in both. Option C is wrong. A sole trader can absolutely prepare a statement of profit or loss for their own management purposes. Option D is wrong because hiring employees is available to any business regardless of structure. The takeaway: when the question asks what's exclusive to a company, think legal personality and limited liability first. Those are the structural pillars that don't exist in a sole trader structure. Question 3. Which two are correct? Question. These require more care because you need both right to get the mark. Read each of the 4 statements individually before looking at the option combinations. The key terms here are partnerships. Notice it doesn't specify general or LLP, so you need to apply general rules for general partnership while recognizing the LLP exception in Statement 3. Statement 1 says a partnership is a separate legal entity. That's false for a general partnership. Only an LLP has that status. Statement 2 says partners share profits in agreed proportions. That's a fundamental feature of any partnership. True. Statement 3 says unlimited liability unless it's an LLP. That's precisely correct. LLP is the exception. Statement 4 says partnerships must publish audited statements. Absolutely not. That's only for limited companies. So 2 and 3 are correct, which is option B. Options A, C, and D all include either Statement 1 or 4, both of which are false. The answer is B. Statements 2 and 3. Partners share profits and losses per their agreement, and general partners face unlimited liability unless the entity is an LLP, in which case liability is limited. Statement 1 is wrong because a general partnership is not a separate legal entity. It's the LLP that achieves that status through registration. Students often assume all partnerships are the same, which is the error being tested here. Statement 4 is wrong because there's no general requirement for partnerships to publish or audit accounts. It's a limited company obligation. The key exam lesson: always distinguish between general partnership and LLP. They are fundamentally different in both legal personality and liability, even though both involve multiple people sharing profits. Question 4, a double-entry bookkeeping question, but it's testing whether you understand what capital introduced actually means in the context of a sole trader. The key terms are capital introduced and cash. Capital introduced means the owner is putting money into the business. What accounts are affected, and in which direction? Option A, debit capital, credit cash. That would mean capital is decreasing and cash is decreasing. That's backwards. That's a withdrawal. Option B, debit cash, credit capital. Cash coming in, capital going up. That makes complete sense. Option C, debit drawings, credit cash. Drawings is what you use when the owner takes money out, not puts money in. Option D, debit profit or loss, credit capital. That's the closing entry for transferring profit into capital at year-end. Completely different transaction. B is the answer. The answer is B, debit cash, credit capital. Using the dead CLIC mnemonic, debits increase assets, expenses, and drawings. Credits increase liabilities, income, and capital. Cash is an asset, it increases, so debit cash. Capital is the owner's equity, it increases, so credit capital. Option A reverses the entire entry. That would suggest cash is leaving and capital is reducing, the exact opposite of introducing capital. Option C confuses capital introduction with drawings. Drawings records outflows from the business to the owner, not inflows from the owner. Option D is the year-end transfer of profit into capital, a completely different transaction. Common mistake. Students who don't distinguish between capital introduction and drawings will pick C. Remember, drawings reduce capital. Capital introduced increases it. They are mirror image transactions. Question 5. Financial reporting obligations of a small private limited company. The word small is doing important work here because it might affect audit requirements. And private reminds you this isn't a PLC. Hold those two qualifiers as you read each option. Option A, must file with a public registry. This applies to all limited companies regardless of size. It's the universal trade-off for limited liability. Very plausible. Option B, must always be audited. The word always is a red flag. Small companies can qualify for audit exemption. Always makes this false. Option C, doesn't need to prepare any financial statements. No, all limited companies must prepare statutory accounts. Option D, must publish in a national newspaper. That sounds like it's from a different era entirely. No such general requirement exists. A is clearly the answer. The answer is all limited companies must file their financial statements with the relevant public registry, such as Companies House in the UK or the Companies Registry in Hong Kong. This is a non-negotiable requirement that applies regardless of company size. It is the direct accountability obligation that comes with the privilege of limited liability. Option B is wrong because small companies frequently qualify for audit exemption based on turnover, balance sheet size, and employee thresholds. Always makes this categorically false. Option C is wrong because even the smallest private LTD must prepare statutory accounts. The obligation to prepare and the obligation to audit are separate questions. Option D is wrong. Newspaper publication is not a general requirement for routine annual reporting. It might apply in specific insolvency-related notices, but not for normal financial reporting. Key takeaway: separate the obligation to prepare accounts from the obligation to audit them. They are distinct requirements, and only one applies universally to all LTD companies. Question 6, a short-form question with numbers. Stella is a sole trader. You're given her opening capital, her profit, her drawings, and her year-end asset and liability balances. Part A asks for her closing capital. Part B asks you to verify the accounting equation. Work through Part A first, the capital account movement, before touching Part B. In Part A, you need capital introduced, plus profit minus drawings. Ignore the asset and liability figures for now. You won't need them until Part B. In Part B, remember the accounting equation is assets equals capital plus liabilities. Add up all the assets listed and check they equal the capital you calculated in Part A plus the trade payables. If they match, the equation holds. Watch the pitfall. Drawings are deducted from capital, not from profit. The answer for Part A, opening capital, is 0. Stella just started. Add capital introduced of $30,000. Add profit for the year of $40,000. Subtract drawings of $25,000. Closing capital equals $45,000. That's your capital account movement. For Part B, total assets are cash $18,000 plus trade receivables $12,000 plus inventories $20,000. That's $50,000. Capital plus liabilities is $45,000 plus trade payables $5,000. That's also $50,000. The equation balances. The SOFP is confirmed. The most common mistake here is deducting drawings from profit rather than from capital. Drawings are not a business expense. They are owner withdrawals of equity. They reduce the capital balance, full stop. If you wrote profit minus drawings equals $15,000 as the net profit figure, that's wrong. The statement of profit or loss shows $40,000 profit. It's only in the capital account movement that drawings are deducted. Keep those two calculations separate and you'll always get this right. Question 7. This is a comparison question using Hadrian and Maria choosing between three structures. It tests all three pillars: liability, legal personality, and your ability to give brief but precise advice. Part A needs one word per structure, limited or unlimited. Part B needs one phrase per structure, is or is not a separate legal entity. Part C asks you to recommend, with one sentence of justification. For Part A, map your structures. General partnership has unlimited liability for both partners. LLP has limited liability. That's the whole reason LLPs were created. Private limited company has limited liability. Shareholders lose only their investment. For Part B, general partnership is not a separate legal entity. LLP is a separate legal entity. It must be registered. Private Ltd is a separate legal entity. Textbook example of incorporation. For Part C, you're advising on personal asset protection, so you need to eliminate the general partnership immediately. Both LLP and private Ltd qualify. Either answer earns the mark with a brief reason. Part A, general partnership, unlimited. LLP limited. Private limited company limited. Part B, general partnership, not a separate legal entity. LLP is a separate legal entity. Private limited company is a separate legal entity. Part C, either the LLP or the private limited company offers the strongest personal asset protection because both provide limited liability. Hadrian's exposure is capped at his capital contribution or share investment respectively. The general partnership must be ruled out immediately as it exposes all personal assets with no limit. The critical exam skill tested here is distinguishing an LLP from a general partnership. They share the word partnership, but are fundamentally different in both liability and legal personality. A general partnership gives neither protection, an LLP gives both. If you wrote all partnerships have unlimited liability in Part A, you'd lose a mark. Also note, the question asks you to advise based on liability alone, so you don't need to discuss tax or governance. Scope your answer to what's asked. A concise, accurate, in-scope answer always beats the long, rambling one. And that wraps up topic A2, types of business entity. 3 things to carry forward. First, incorporated entities give you limited liability and separate legal personality. Unincorporated give you neither. Second, always distinguish between general partnership and LLP. They look similar but are legally worlds apart. Third, drawings versus dividends. Get the terminology right for the entity type. Next up is topic A3, where we start building on this foundation. See you there.